Good afternoon, everyone. Welcome to today's live section on taxation. Okay. Okay, Okay. Good afternoon, everyone. Welcome to today's live section on taxation. Okay. Like you know, this is a revision class. I expect that you must have read or watched the videos on taxation. Maybe there's some areas you need more clarifications. So as we go on, just ask questions in line with those areas. So what are the topics? We have of course, some of the key topics: basis period, capital allowance, taxation. We also have company taxation or company income tax. Then we'll have personal income tax, where you have employment income, taxation of employment income, taxation of sole trader, taxation of partnership income. Then we also have estates, trusts, and settlements. So these are the key topics. We also have some transaction taxes like VAT and what have you. Okay, so these are some of the key topics you need to be conversant with for the purpose of the exam. Okay, all of them are examinable. All right, so like I said earlier, I expected you must have watched the videos, taken note of all this. Maybe in your course of reading, you may have some gray areas you need clarification. So I want your questions to keep coming in. But let's start with basis period. Okay, you know, basis period is more of how to get, how to determine those three things: tax years, basis period, and assessable profits for those three categories of business: commencement of trade, for cessation, of trade or business for change in accounting date, and of course existing business. So how do you get the tax year, basis period, and assessable profit for these four categories of businesses? A business that commences operation, a business that ceases operation, a business that changes accounting date, and ongoing business. Okay, so we just take commencement. For commencement, remember, commencement of trade or business. So for commencement of trade or business, we say we have new rules, the old rule, and we have the new rule. Remember the old rule? The old rule is before the Finance Act, while the new rule is the Finance Act. Okay? So in the old rule, we normally do two computation. We have the normal assessment, which is also the original assessment. So used in the old rule of the commencement, we do two computation. The first on normal assessment, then we have revised. That means two computations will be done so that one will be chosen, okay? And it's the taxpayer that has the right of election. Of course, every taxpayer will choose the one that will reduce his tax liability, okay? So now, how do we determine the tax year, the basis period, and assessable profit using the old rule? So we try to remind ourselves of the commencement rule, the old commencement rule and the new commencement rule. For the old rule, in the normal assessment, the first tax year, what profit are we to tax? Remember, we tax profit from date of commencement to 31 December, to December. Profit from the day the business commenced to December. That's the profit you tax in the first year of the normal assessment. That's the old rule. In the second year, we tax profit of 12 months. So we tax 12 months profit from date of commencement. So profit of 12 months beginning from date of commencement. So date of commencement is 12 months. Then the third tax year, we tax 12 months profit on preceding year basis. Remember what this means? We tax 12 months profits on preceding year basis. So these are the profit we tax for the first 3 years of the commencement using the old rule under the normal assessment. Now for the revise, in the first year, the profit to be taxed in the normal will be the same as that of the revise. So in normal, the revise, the first year of the revise, we tax profit from the date of commencement to December. The same thing. So it's still profit from date of commencement to 31st December. Okay? So when you have the change between the revise and normal is in the second and third year. So in the second year of the revised, we tax on profit on actual year basis. Remember, actual year basis means the tax year will be the same with the end of the basis period. The same thing with the third year on actual year basis as well. So the second and third year of the revised is on actual year basis. That's where you have the difference. So remember, the first year, both for the revised and normal, is the same. Where you have the change or changes is the second and third year for both normal and revised. For revised is on actual year basis or true. Now, let's come to the new rule. For the new rule, we are not doing two computations, just one computation, because there is no more overlapping, there is no gap, there is no coincidence of period. Okay? So we do only one computation. And what is the profit you tax in the first year of the new rule? You tax profit from date of commencement to end of the first accounting period of the business. Profit from the date of commencement to the end of the first accounting period. Remember, the old one said till December. Why this one say till the end of the first accounting period? Okay. Then the second year of the new rule, we tax profit from the next day after the end of the first one. Next day, profit of next day after end of the first accounting period to end of the second accounting period. So those are the profits we tax in the second year, remember. So in the third year, we also tax the same profit of next day after the end of the second accounting period to the third, to the end of the third accounting period. So that is the profit we tax in the third year. So for the new rule, we just do one computation. While for the old rule, we do two computations, normal and revised with size right of election. So there's no right of election in the new rule. Now, when do we use the new rule? So it depends on the date of commencement. Okay? Commencement date. Before 2019, we use old rule. Why commencement date after 2019? Okay, from 2019. We use new rule. So meaning you check the question. Check the question. Check the date of commencement. It's the date of commencement that determines whether you are using new rule or old rule. So if the date of commencement is before 2019, use old rule. If it is from 2019, you use new rule. So that is it about basis period. Okay? And remember, at this level, they can test basis period as a full question. So you must know how to do this for both the old, new, and know when to do old and when to do new. Okay? Know how to get your figures right. Okay, so I expect your questions on basis period as we move to the next one. Capital allowance. Now, capital allowance has to do with what? A relief that is granted to a taxpayer that incur cost on qualifying capital expenditure. That means once you buy an asset, PPE, property, plants and equipment, then the company will be giving capital allowance in lieu of depreciation. You know, depreciation is not allowed in tax. So in place of depreciation, the tax authority will grant capital allowance. Remember also the types of capital allowance, okay, that we have: initial, we have annual, we also have investments, okay, we also have ordinary rural investments. There's also balancing allowance. So all these are types of capital allowance. The major ones are initial and annual allowance. Okay. Now, you know that initial allowance is claimable once on all qualifying capital expenditure. Okay. It's claimable once on all qualifying capital expenditure, on all assets. Okay. But remember, that asset must be put to use in business before you can claim capital allowance. How do you calculate initial allowance? Remember, we said the rate, the initial allowance rate times the cost of the assets. That's how we compute it. Just the rate times the cost, the stretch computation. The initial allowance rate, all asset has its own initial allowance rate and annual allowance. So the initial allowance rate times the cost of the assets. Okay? Now, annual allowance is claimable on what? It's claimable annually is a type of capital allowance that is claimable annually. Remember, and it's claimable on straight line. On straight line basis. Okay? So you claim it annually, all through the tax life of an asset. If an asset tax life is 4 years, like plants and machinery, then you claim the annual allowance 4 times. Every year you claim 4. But you claim on straight line basis. Okay. Now, how do we compute annual allowance? There are 2 formulas. One is for new assets. The other is for old assets. So if the asset is new, the annual allowance will do cost of the asset minus initial allowance over the tax life of the assets. So this is the formula you use for new assets. For old assets, the annual allowance is tax written down value, because the asset is on tax written down value, that's why it's old, over the tax life minus the number of years that have been claimed. Okay, so this is the formula for old assets. This is for new assets. Remember, new asset means that this is the first time we are claiming capital allowance on this asset. Old asset means that we have claimed for some years. We are continuing from where we stopped. So the asset is on tax written down value. So once you see assets on tax written down value, you know that is an old asset. So for old assets, this is the formula I use for the annual allowance computation. And of course, you know, annual allowance must be prorated. You prorate annual allowance. If you have basis period that is shorter than 12 months, especially in the commencement, first year of commencement, where you may have the basis period of assessment shorter than 12 months, then you need to prorate annual allowance. But you don't prorate initial allowance. Take note. You claim initial allowance in full. All right. We also have investment. All these are additional allowance. So investment allowance is just like initial. It's claimable once. But the thing is that it's not claimable on all assets. So you don't claim investment allowance on all the assets. You claim investment allowance on claimable on plants, machineries, and equipment. So it's not on all assets. You can't claim investment allowance on motor vehicle, on furniture. Okay? So it's plants, machineries, equipment. Initial allowance you can claim on all. So that is one of the difference. Okay, and of course you know that you claim investment allowance in case if you don't have enough profit to claim all. The tax planning there is that take investment allowance before initial and others. Okay, because once you fail to claim initial investment allowance in any year, in the first year, then you cannot claim it again. Okay, so that's why the ranking is always claim investment allowance if the profit is not enough to cater for all the capital allowance. Okay. Now, we also have rural investment allowance. This is for businesses that are situated in rural area where there is no electricity, water, tarred road. Okay? Or maybe those facilities are available but they are 20 kilometers away from where the business is situated. Then you can claim this allowance. But remember, the business, before the business can claim this allowance, the business must have invested. That's why we call it rural investment. That means there's no electricity, the business has provided electricity. There's no water, the business has provided water. There's no tarred road, the business have also constructed the road before it can claim such allowance. Okay? Now, the Finance Act also deleted these two. So that means investment allowance and rural investment allowance have been deleted by the Finance Act. But for exam purpose, you have to look at the year you are given. Okay? Because according to the Finance Act, it takes effect from after August 2023. So this investment allowance deletion is after August 2023. So that means if you have a question that is before August 2023, the year is before August 2023. So it means that you have to also compute investment allowance. But if it's a question that is after August 2023, there will be no computation for investment allowance. And remember the rate. The investment allowance is calculated as 10% of the cost. So the rate of the asset times the cost of the asset. That's all. For plant, machineries, and equipment, including generator, remember. Okay, 10%. So that means you have to check the year you are given to know whether to compute investment allowance or not. Okay, so that is how you go about it. Okay, so the last one is balancing allowance. When you dispose an asset, that asset you have been claiming capital allowance on, you need to do balancing adjustments. Okay, now your balancing adjustment could result to balancing charge or balancing allowance. So what I mean is that you have disposed any of the assets you have been claiming capital allowance on. You need to do what is known as balancing adjustments. So how do we do balancing adjustments? We compare the sales proceed. That means we are amount to realize from the asset disposed with the tax written down value. The tax value of the asset as at the time it was disposed. That's what we compare in doing balancing adjustments. So the sales proceed less the tax written down value. That will give us either a charge, balancing charge, or balancing allowance. So allowance is usually negative. So if the sales proceed is more than the tax written down value, you have a charge, balancing charge. If the sales proceed is less than the tax written down value, you have an allowance. Now what is the implication? If it's a charge, it's taxable. You are going to pay tax on it. If it's an allowance, then you have a relief. You're going to claim a relief on it. How do you treat balancing charge? It's taxable, like I told you. Add it to what? You add to your assessable profit so that it will be taxed together. Add to assessable profits, they will be taxed together. How do you treat balancing allowance? It's a relief. How will you claim the relief? Add to capital allowance so that they will be claimed together. No capital allowance is a relief. So that is why we say the balancing allowance is a type of capital allowance because it goes with capital allowance. Okay, so all these things are what you need to know. And of course, computation. You know that the examiner will ask you at this level to compute capital allowance. It could be a full question, just compute capital allowance. And of course, you also remember that in computing capital allowance, there is something you must do. You have to allocate the assets using what? Basis period for capital allowance. Remember, basis period for capital allowance. So you allocate the assets. What are the assets you need to allocate? You allocate new ones, old ones, also the disposed ones. Why must you allocate new one? Remember, so that you know the first tax year to start. Old ones, so that you know the number of years have been claimed, and of course disposed ones, so that you know when to write off and do balancing adjustment. So all these things, you have to know it. So capital allowance at this level also can come as a full question. So you should be ready to do all this. Now, your company income tax. Okay, I also expect questions from capital allowance, but if there is none, company income tax will be testing basis period, capital allowance, and tax liability. That's what it will be testing here. So the examiner may decide not to give you these two, I'll just give you capital allowance, knowing fully well that you need basis period, knowledge of basis period, and capital allowance to do company income tax. So how do you compute the tax liability? Of course, you know that now companies are classified into three. Okay, companies are classified into three. You know, you have small companies, medium, large size companies. And that the classification is based on what? It's based on turnover of the business. So it means that when you are given question, find out whether it's medium, small, or large size company, so that you know the tax rate to use. Okay? So remember that. Now, how do you compute the tax liability of a business? They will give you income statement. So in the income statement, you see the profit. Okay? So under the normal basis, we call it the normal basis. Under the normal basis, the accounting profit you are given, whether it's called net profit, whether it's called profit before tax, or whether the business declared loss for the year, start with it. So if it is profit, it will be positive. That's just the difference. If it is loss, it will be negative. So what do you do when you have gotten the accessible profits? The next thing is, the first adjustment is to add back disallowed expenses. Those expenses that are not allowed in tax, you know them already. General provision, increase in share capital, loss on sale of assets, and so on and so forth. So if you have them and they have been deducted from the income statement, you add them back. So that's the first adjustment. Then the next thing, you add taxable income omitted. So maybe there are some income that was not reported in the income statements. They are taxable, but they were not included in the income statement. Since they are taxable, what do? You include them. So you add. The next thing, you less non-taxable. So non-taxable, maybe the income are non-taxable because they are exempted from tax. Okay? Like some certain dividends are exempted from tax. Frank investment income. Okay? Exempted from tax. They are income that are specifically exempted. So if you have them in the income statement, what do? You remove them so that they will not be taxed. Or maybe some are not taxable in this tax act, that is under company income tax, or they are taxable in a different tax act. So what do you need to do? Remove them here so that they will not be taxed here and taxed in the other tax act. Okay? So for instance, profit on sale of assets is not taxable in CIT, it's taxable in CGT. So if you have it in the income statement, remove it because it's going to be taxed under CGT. So if you have them, you take them away. The last adjustment is you less allowable expenses omitted. So if there is any expenses that is allowed but was not reported in the income statement, since they are allowed, you help and removed. So when you have done this, you have gotten what is known as adjusted profits. So you are saying that these accounting profits have been adjusted. It's now suitable for tax purpose. Because you can't tax accounting profits, you must adjust it. Okay, so that's the first part. When you have done that, you can go to the tax liability section now. This is the tax liability section. The tax liability balancing charge. Remember I told you about balancing charge earlier? Look at it here. Told you balancing charge is taxable, add it to assessable profit. So this adjusted is assessable. You add balancing charge to it if you have it in the question. Then you less loss brought forward. It must be loss brought forward from previous year, not the current loss. Companies cannot relieve their loss on current basis. Company relieve on carry forward. That means it must be loss of previous years. If you have them, you bring them forward and relieve them. And of course, you know there is no restriction to loss. Okay, losses can also be carried forward indefinitely. So you relieve the loss. When you relieve loss, you have something here. Then the next thing is capital allowance. So you compute your capital allowance, or if you are given what the capital allowance is, so you just relieve it here. And of course, when you are relieving capital allowance, you test for restriction. Unless it's exempted from, the company is exempted from restriction. So let's assume you take away the capital allowance, you have this. This is called total profit or taxable profit. So this is the profit you can tax. Then you tax the profits at the applicable rate. If it's a small company, you use 0%, medium, you use 20%, large, you use 30%. Then every Nigerian company must pay education tax at, depending on year, it could be 2%, it could be 2.5%, it could be 3%. Okay, so you use the applicable rates, looking at the tax year you are computing for. All right, so that is how you go about it. So when you have, this is the tax to be paid. Of course, you know the issue of minimum tax. Remember, you know when to do minimum tax or not. You compare the tax as per normal and that of minimum tax and all that before. So CIT normally most times is given as number one question. Okay, but that does not mean that they may not. They can bring other topics, but most times you see CIT as number one question. So it's testing these whole principles: basis period, capital allowance, tax liability, and all that. So if you are good with all this, then you are at least you should get no less than 30 marks from These three. Okay. Now, this is companies. We are moving to individuals. Personal income tax. Remember, we have two types of taxpayers. So we can classify taxpayers into two: individual taxpayers or corporate bodies. Individual taxpayers or corporate bodies. So if you are paying your tax, it's either you are paying as individual or you are paying as a company. So those are the two types of taxpayers we have. All right. So personal income tax. Or we can say taxation of individuals. So the two types of taxpayer, like I said, is corporate bodies and individuals. So it's either you are paying your tax as an individual or you are paying as a company, as a classification. So the CIT takes corporate bodies. So everything about taxation of corporate bodies is under Company Income Tax Act. So this TIT is for corporate bodies. Why PIT takes care of what? Individuals. So when we say personal income tax, it means we are looking at taxation of individuals. Okay, so who is an individual under personal income tax? Remember, an employee is an individual. Anybody that earns employment income is an individual. Okay, sole trader is also an individual. If you have a sole trade business, a one-man business, okay, the owner is an individual. The profit is taxed in the hands of who? The owner of that business. Okay, partnership income business is also, if it registers as an enterprise, is also seen on, is also taxed under individual. So each of the partners will be taxed as individuals under Personal Income Tax Act. Okay, estate, trust, and settlements. Okay, income arising from there also will be taxed under Personal Income Tax Act. So these are, so under Personal Income Tax, you see you have 4 key topics under it. So that's to tell you that a whole up to 40 marks can come from personal income tax, because they may set two of the 4 topics in a diet. They may set employment income and trustee, or they may set sole trader, employment income. They can choose any 2 per diet. So if you know your PIT very well, then at least you get not less than 40 marks from it. Okay? And of course, remember the template for calculating the payee. Okay? You must know how to calculate payee under personal income tax for employment income, for sole trader, for a partnership income, then estate trust and settlement. Okay, so remember the template. So we have for employment income, it's just for you to classify the income as earned, remember, earned income, earned income, and unearned. What are the earned income? Their salaries, your wages, all your employment income, they are your earned income, your allowances, housing allowance, transport allowance, medical allowance, and so on and so forth. Your benefits in kind, all of them are earned income. Okay, so you bring them together. Salaries and wages. What else? Allowances. Benefit in kind. You know what benefit in kind is? Non-cash payment, non-cash benefit, but what with monetary what values. So if you add up all this, your earned income, that's your emoluments, gross emoluments. Okay, so you now add your unearned income. Your unearned income are mainly your investment income, like income from dividend, rent, interest, and what have you. All these are unearned income. Okay, so if you also have gratuity, let me put it here. Gratuity is part of earned income, so you also include it. All right, your unearned income will be your investment income, dividend received. Remember, gross. Any investment income you are bringing here must be gross. So it must be gross. All the investment income must be gross. Then interest, rent or rental income, and so on. All of them gross. Then what else? Okay, let's say this is all the unearned income you have. So you have to sum them up as well. So this is called your total. So your earned plus your unearned is called your total income. When you have your total income, you less tax exempt items. So among the income, maybe there are some that are exempted from tax. You have to remove them. For instance, gratuity is exempted from tax. For instance, dividend, you're exempted from tax. So you have to remove them so that they will not be taxed. But you first include gratuity as earned income. You also include dividend as unearned to get the total income. Then you remove those exempted from tax. So tax exempt items, this gratuity will go out. The dividend will also go out. So you take them out here. Then you now you remove those reliefs, all those contributions that forms the reliefs. So less reliefs. So you less all the reliefs apart from consolidated relief allowance. Remember, what are the reliefs? All those contributions to NHIS, National Health Insurance Scheme. If you have contributed to that scheme, then the amount you contributed is a relief for you in doing your personal income tax. So which other contributions? There are many contributions. National Pension Scheme. Okay. If you have made contribution of such nature, you remove it. Also, insurance premium. Insurance premium. You remove. So we have contribution to National Pension Scheme, insurance premium paid for up to the spouse, not for a child. So if you have all those things, you deduct. There are other contributions. Like for instance, if you also have mortgage. From here. So this is what we mean by gross income. So when you remove the relief, you have the gross income. When you have the gross income, this is the income you can now relieve the CRA, consolidated relief allowance. So consolidated relief allowance is the last relief you take. So we can now say less CRA. How do you compute it? Lower, is it lower? Higher of 200,000, higher of 200,000, or 1% of gross income. Remember how to do it. So the higher you add plus 20% of gross income. This is how you do CRA. Okay, be reminded. So you pick the higher, add 20% to it. So let's assume this is our CRA. You deduct from here. You have something here. So this becomes your chargeable income. So this is the income that will be charged to tax. So when you have your chargeable income, what do? You tax it. An individual have graduated tax rate. Remember, for individual, you say first 300,000 will be taxed at what? At 7%. Next, 300,000 will be taxed at 11%. Next, 500 will be taxed at 15%. Next, 500,000 at 19%. So we have used 1.6. 300 plus 300 plus 5 plus 5. That's 1.6. So we say next 1.6. We tax it at 21%. So altogether we have used 1.6 plus 1. That's 3.2. So we can now say above the balance that is above, any amount above 3.2 will be taxed at 24%. So this is the graduated rate. We apply this. What you have here, the total of this, if all are applicable, this will be supposed to be the tax liability. Okay? Tax liability. So this is the full template for your personal income tax or your payee computation for individuals. Are we together? This is earned income, classify your income, and unearned. Then you have your total. You less tax exempt items, less reliefs, less CRA, you tax. Okay? So that is how you go about it. Okay? Now, what of sole trader? Sole trade is a business, so it's an enterprise. That means one-man business. So if it's a business, it means it's not earning employment income. Maybe it's earning profits. So there will be income statement, just like you have on that company income tax. You'll be given income statement. And once you are given income statement, it means you have accounting profits. And what are you supposed to do? You have to adjust the accounting profits. So the same thing you did in CIT, you have to adjust that accounting profit. Those for adjustment, remember? Profits, add back disallowed and all that. You have to do that to get the profits that is suitable for tax purpose. So that's what you are going to do here. So for sole trader, you must adjust the income statements to get the one that is suitable for tax purpose. So when you are done with that adjustment, you now come and do this computation, which is the personal income tax. So for sole trader, since it's a business, there will be two computations. One is you first adjust the business income. Then two, you do your personal income tax computation, which is this. So the difference here is that there will be business income as earned income. Let's say business income will come here. So the income from the business that you have adjusted will come here. That's just the difference. But if it's employment income alone, there will be no business income. But if it is a sole trader, then the business income after having adjusted will come as earned income. Because this sole trader may also be an employee somewhere. He's also earning employment income. So his income from business will come as earned income. His salary received from his employment will also come. And maybe he has other investments. They will also come. Are we together? So the same computation for the personal income tax. The only difference for sole trader is that there will be income statement that you must first adjust. Okay? The result of that adjustment is what you are bringing here as the business income. Okay? So that is just it. But the computation we also follow. The reliefs are also the same. Every computation we have done here is something you do for sole trader. Okay? So the profit is taxed in the hand of the sole proprietor. Okay? It's the sole proprietor that pays his tax as a person. That's why it's under individual. Then the same thing applicable to partnership. For partnership income, the business is also a partnership business. It's a business, it's an enterprise. Okay? So meaning there will also be income statements. What are you supposed to do? You must first adjust that income, that business income. Okay? You must first adjust. But the difference is that that profit from the business does not belong to one person. That's why it's partnership. It belongs to the partners. Okay? So the partners could be 2, could be 3, could be 4, could be 5, and so on. So it means that when you arrive at the adjusted profit and taking care of all what you have to take care of, the profit, which is known as divisible profit, will be shared among the partners in their what? Profit or loss sharing ratio, which will be given to you in the question. So you share the profit, so that each partner will go with his own profits. So for traditional partnership, we don't tax the business. We tax the income in the hands of each of the partners. So the profit from the partnership business will be shared among the partners. So each of the partners will be taxed separately as an individual. That's how it works. Okay? So that's how. So that means in partnership taxation, we first adjust the income statement, because the income statement is for the partnership business. So we have to adjust that profit. So we say net profit or profit before tax or whatever it's called, or loss for the year, add disallowed expenses, add taxable income omitted, less non-taxable income, less allowable expenses omitted. You have the adjusted profit. Then you can take care of capital allowance and all that. You want to treat it there. So when you have gotten that, what you have is the divisible profit. Then you can share it among the partners. So each partner will know his own share of profit using the profit or loss sharing ratio. Okay. Now, when you have done that, then you come to the personal income tax computation section. That's this now. The difference here now on partnership is that for partnership, we are going to do 1 for each of the partners. So if there are 3 partners, this first computation will be for the first partner. Then we'll also do another computation for the second. So each partners are taxed separately. Okay? So we don't tax them together. But the profit will be adjusted. The income statement, because it's 1, will be adjusted. Then the profit will be shared. Each partner will bear his own responsibility, will pay his own tax in accordance to all the income it earned. Okay, so that's how it works for partnership business. And you know that partnership business is guided by the Partnership Act. Okay, take note of that. Now, there is also a situation whereby there may not be partnership agreements. Remember, partnership business may have a partnership agreement. Okay, there is also a situation where they may not have partnership agreements. The law says that if that happens, the partners are deemed to be what? Equal partners. And what is the implication of being equal partner? It means that the profit or loss will be shared equally. Okay? Each of the partners will contribute the same amount. Okay? Number 3 is that no partner will be entitled to salary. If there is any partner that will be entitled to interest or loan, then it will be at 5%. Are we together? Where there is no agreement, where there is no partnership deed. But where there is partnership deed, then everything must have been spelled out on the partnership agreement. So it follows suit. So take notes of that. And we also have issues that we call change in partnership. Change in partnership. So they may ask you, when do we say there is a change in partnership? There is a change in partnership if there is admission, when a partner is admitted. Admission of a new partner. So once a partner is admitted, then the structure of the partnership business have changed. There is a change in partnership. Okay? Now, number 2 is retirement, resignation, death of a partner. So when a partner retires or dies or resigns, then there is also a change in the structure. There's a change. Then 3 is amalgamation. A partnership business may merge with another partnership business. Then there is also change in partnership. Then the last one is conversion to limited liability company. So a partner may decide to become a company. You know, it's an enterprise. You may decide to become a company. So if that is the case, there has been a change in the partnership business. So you also need to know the tax implication of each and every one of them. Like if a partner is admitted, what does that mean? What's the tax implication? It means that the new partner that is admitted is deemed to have commenced business. So you use the commencement rule to tax that new partner. Okay, so that's the implication. But if this new partner just resigned from a similar partnership business to join this new one, then he's deemed to be in continuous business. Then you use preceding year basis. That's the tax implication. Okay, take notes, be reminded. Then, if a partner retires or resigns, what's the tax implication? The partner that retired or resigned is deemed to have ceased business. So what rule we apply? You use cessation rule. But if he's resigning from this partnership business to take up appointment in a similar partnership business, then he's deemed to be in what? Continuous business. Then you use preceding year basis. Okay, so those are the implications. All of them have implications. So at times the examiner may just ask you to state the implication of this following change in partnership. So you should be ready to know the implication, apart from the computation, which is the general thing. So I think those are the things you need to know. I expect to see your questions. Okay, so of course, you know about transaction taxes, taxes on transaction, like your VAT. Okay, your VAT, your withholding tax, your custom and excise duty, your stamp duty tax, and luxury tax, and so on and so forth. Those are your transaction taxes. That is the area, another area questions can come under. So let me list them so that take note of them. So under transaction taxes, we have VAT, which is your value added tax. The tax you pay on the value added on consumption of goods and services. You know how to compute it. Output VAT less input VAT. Okay, so take note of that. We have withholding tax. That's WHT, which is an advance payment of your income tax. Advance payment of income is not another form of tax. So there's nothing like Withholding Tax Act. It's just an advance payment of your income tax or your personal income, company income tax or your personal income tax. That is withholding tax. Then we have luxury tax. That's a tax paid on luxury goods and services. Okay? Luxury items and all that. So if you buy those luxury items, your yacht, mansion, and all the first class tickets and all that. Okay, the luxury tax. So you take note of that. Then we also have custom and excise duty. It's also a transaction tax. And excise duty you pay on import and export. Okay, so and also on goods manufactured in the country and all that is still on that part of it. So you need to know this. So these are how the questions will come. I told you earlier, basically CIT in most cases will form the compulsory number one question, but that does not mean other topics may not be set with that regard. But most times it's CIT for 30 marks questions. So we familiarize yourself with CIT. Then personal income tax, try to know how to do employment income, sole trader, partnership, estate, trust, and settlements. Among these four, at least you see no less than 2 in a diet. So if you know the 4, then it's as good as getting like 40 to 50 marks, okay, from this alone, okay, in addition to your CIT. And that's all. So capital allowance also at this level or basis period can form a full question too, okay, at this level, at this skills level. They can ask you basis period capital allowance as a full question. So meaning all these topics that are listed here, they are all important. So when you also come to transaction taxes, okay, they may also ask you any one or two, okay, anyone you see, maybe your 15 marks questions, number 6 and number 7 may always come from all this, okay. And remember at the beginning we have introduction to tax and all that. So also try to know the tax administration and all that. Those will form your 15 marks questions in addition to that. So I think if you are familiar with all this, you will not have issue with your exam. So in the absence of any question, I think we'll have to stop here for today. Okay? We also want to use the opportunity to wish you success in your forthcoming exam. We know you have done your best, okay? And God will crown your efforts. Your effort will not be in vain. You'll come out victorious and successful. Thank you so much for paying attention. Thank you.